From New York City for our viewers worldwide, I'm Jonathan Ferro. This is Bloomberg Daybreak. Ahead of a big data dump here in the United States. This is how the stage is set cross-asset. Futures a little bit softer this morning. -6 on the S&P 500, -44 points on the Dow. Even with yesterday's record highs, some of that enthusiasm, at least in this morning's session, coming out of the market. Switch up the board then. Treasuries very well bid throughout much of the session. Yields lower by 2 basis points, 247 your yield on a US 10-year. And the dollar on offer as the data drops with a downside surprise for housing starts. That's where we'll begin. Month on month coming in at -2.6%. Median estimate was 0% flat, so a slight downside surprise on housing starts. Building permits, month on month, an upside surprise, coming in at 4.6%. The median estimate was 0.2%. And initial jobless claims just doing what they do, grinding lower, 239,000. So a downside surprise, which is largely seen as positive, coming in at 239. The median estimate in a Bloomberg survey was 245,000. So the labour market looking tight, the housing situation rather nuanced. Let's bring in the team. Steve Rasciuto, Mizuho Chief Economist, and Trey Parker, Highland Capital Management Partner and Head of Credit. Steve, let's begin with you. Let's just go with jobless claims to begin. Tight, that labour market, at least as far as the headline numbers are concerned. Has anything changed for you?
No, I mean, we expect where we are in this part of the business cycle to be seeing these kinds of levels of claims. I mean, people are looking at them saying claims are abnormally low. The reality is the correlation between claims and employment is broken down somewhat. So these numbers are consistent with the labor market we've been seeing, which is about 175, 180,000 per month in payroll employment.
Well, here's the Philly Fed business outlook, 43.3, the median estimate 18. What does that scream to you, Steve?
Well, I mean, the problem, I think, with all these things is the expectational sets.
Yeah.
You know, all these ISM-type numbers, this is the problem I have with Europe as well. It's all driven by ISM-type numbers, which are optimism. And everyone's assuming that Trump is going to be able to fix the world's problems. I'm not so sure Trump is going to be able to fix the world's problems. And I think all these expectational numbers will come down as time progresses. I think we'll be dramatically lower in all of them by the time we get to the middle of the year.
But Trey, what's an investor to do? Because if you don't look at the ISM numbers, you're looking backwards. The ISM numbers are thought to be, that's the only way to look forward. So what do you do as an investor?
I think you've got to be careful in terms of what expectations you set in underwriting deals and underwriting credit going forward, because certainly I think a lot of the positivity has been priced certainly into the equity markets and in the credit markets as well as people search for yield on a global basis.
Steve referred to the business cycle, where we are on it, and most people think we're getting put a little bit long in the tooth, and the question really is whether President Trump can extend it. How critical is that to investment decisions?
Certainly you've seen the analyst spirits pick up in the markets, and I think that's extended a lot of people's optimism. It will be important to see the fundamentals actually start to flow through. We've obviously seen substantial earnings growth coming into the fourth quarter, and I think the year-over-year comps are going to be easy in the first quarter, but again, a lot of the changes we're expecting on the regulatory front and from a tax perspective are going to take longer to come to fruition.
You look at these outlook numbers, though, Steve, and you've got to ask the question, whether we get the package from DC or not, can the confidence result in a pickup in economic activity, the hard data, regardless of what we get from DC?
Well, it will. I mean, we're going to move up from last year's 1.6% to 2.3%.
Yeah.
Okay? But that's about as far as that's going to get you. And then you're going to need to have real things kick in to keep you on that upward trajectory. You know, a lot of people's estimates were we were down around 2% for trend. And so moving up to the 2.3% gives you some cushion where you could lose some momentum if you don't get some real follow-through. I do believe the deregulation aspects, the DEP, the Dodd-Frank, will help get us forward to 2.5%. But unless we get housing kicking in, which was a disappointing housing starts number today, I don't see how you're going to get to 3+%. As the Trump administration, as a lot of the equity bulls would like to see going forward.
Significant upward revision to the previous month on housing starts is worth considering, but I take your point. Trey, as you look at the situation, the story is an optimistic one. Let's talk about the price of the story in credit right now. It looks incredibly expensive. What is your view on that?
Yeah, certainly the broader credit markets have seen a huge bid, in particular floating rate, as people have looked for an inflation hedge in some place to mitigate the potential risks of rising interest rates. I think there are certainly sectors that are underperforming and beleaguered, if you will, relative to the rest of the market, and I think you have to be careful looking at those opportunities, but you look at sectors where I think there are still opportunities like retail, certainly an industry that's going through secular shifts, but a sector where there are going to be winners and losers based on what the consumer is doing. Obviously, where we are in the job cycle in terms of full employment and wage growth, I think that there is a potential bid, for consumers to improve.
So Trey, when we talk about the growth numbers that Steve was talking about, 2.3%, 2.5%, shouldn't we just get used to it, that this is the new normal instead of a 4% number, in the sense that you have to get productivity really growing again, and no one seems to have a plan for that?
And you have to have investment to follow that. And I think that's the real concern. I think that there's a lot of optimism around an improving demand environment, but not a lot of companies willing to put capital behind that to enhance capacity, to enhance productivity, and to see further upside to economic growth.
In part because they can't see the real growth in demand. They can't see it in the top line.
Well, when you look at the national income share going to the corporate sector, it's starting to erode. When you look at margins, they've kind of reached the peak. When you look at global excess supply and pricing power, yes, even though the CPI number was up yesterday on rentals and on energy, you go through the numbers and you really don't have any real upside potential. So with that lack of pricing power, what's the logic to go out and invest in new equipment, especially in a world of excess supply of most of this product? So that get pulled back. The other thing is we've reached the cap that we can go on automobiles. So all we've got left is housing, and that's where the rubber has to meet the road, and that's why watching the housing data, I think, is a heck of a lot more important for what's going to happen going forward than watching the ISM type numbers.
Do you have any sympathy for the Federal Reserve, Steve?
Do you have any sympathy for the Federal Reserve? I think they've put themselves in a very, very bad position, and I think it's going to be very hard for them to extricate themselves from it. I think they're trying very hard to do it. They're taking some appropriate steps in terms of moving very, very slowly. But I have less, comfort, I should say, less sympathy for somebody who's put themselves in a bad situation.
Well, let's talk about that bad situation that you believe they've put themselves in. Kevin Warsh, a name that I hear a whole lot more about these days, former Fed governor, and in many people's minds in line to maybe take over at the Federal Reserve. In an op-ed in the Wall Street Journal just last month, talked about the data dependence of the Federal Reserve guys and referred to them almost as day traders. Yes, data dependent, yes, but moving around and jumping around like day traders. Do you think that's true?
Look, I think at the end of the day, Janet Yellen is a labor economist, and she's watching the tightness of the labor markets. I think that they are definitely worried about getting behind the curve. And so we think some of the data that's recently come out of CPI and some of the job opening we've seen is certainly begging for a rate rise before the middle of the year, before June.
So let's ask the big question, Steve, that Kevin Warsh suggests. Congress, people in Congress would like to help the Federal Reserve get out of that jam by essentially having rules. So it's not data dependent, so they can't jump back and forth and things like that. What would that mean? If that went forward in Congress, what would that mean for the economy in the long term?
I'm much more of a fan of discretion rather than rules-based monetary policy, because anytime you set a rule, the system finds a way to game the rule. So to me, it's much easier to just go by discretion. Where I think the Fed made a big mistake is they've tried to resolve this all through interest rates and their portfolio, instead of looking at their regulatory approach, instead of looking at the bully pulpit that they have. And Donald Trump has proven how well, the bully pulpit can be. And the Federal Reserve walked away from those two very important tools years ago. And I think it's time they bring those tools back to allow them to be more flexible in some of the other tools. They've boxed themselves in on what little they can actually do, and I think that's a big mistake.
Okay, if that is your approach, do you take a solace, encouragement from the executive order from the White House saying we're going to take a hard look at all these regulations now? They might get some assistance from the White House to get some of those regulations out.
Well, I think that's exactly what's going to happen. I don't think you have to change the regulations. To a certain extent, all you have to do is change the interpretation of some of these regulations. I mean, we've put very, very, very onerous restrictions on a lot of these financial institutions. And if you look at the loan-to-deposit ratio in this country, it is actually abysmal, which is one of the reasons why this economy can't get going. Everyone's so paranoid about leverage, but you know what? Leverage is the grease that makes the wheels spin. And without that grease, the wheels eventually seize up. And that's been part of the problem in here.
As far as that reference to day traders goes, a Bloomberg client just messaged me and said, nope, tick traders. So maybe it's a little bit more aggressive than that. Trey, as you look at things, this situation's with the loan market, the president of the White House truly believes that they need to take the regulation and strip it back because these businesses, these small businesses that want loans can't get them. Is it a demand problem? Or is it a supply problem?
I certainly think that the deregulation or the watering down of the regulation of the banks is going to improve the transmission mechanism through the banking system. And I think the small business optimism that it's at a 5 standard deviation high certainly is prepared to seek new credit and to see business growth. And I think that's exciting for the economy. The real question is, will they actually make those investments, and will we see that regulation? How quickly?
Okay, many thanks to Steve Rasciuto of Mizuho and Trey Parker of Highland Capital Management.